Market makers are pricing in an $11.50 move for Nvidia during tonight's massive AI earnings event.
Trade Brigade's Matt deWolf examines the data and asks, will the market hold or face a total liquidation break?
Matt deWolf is calling today the main event. It's finally Nvidia earnings day, but the broad market looks like it's stuck in a junk drawer.
Exactly. We're smack in the middle of a balance range. The S&P 500 and Nasdaq are just chopping because nobody wants to be first before Jensen speaks.
Wait, so even with all the big data dropping this morning, we're just supposed to sit on our hands?
Matt is clear. Nvidia is the one stock to rule them all right now, and it marks the last major milestone before we hit a dormant period.
The market maker move is priced at $11.50, or about 5%. After Jensen's call, the rest of the market will finally know which way to break.
We just got a smattering of data. Core PCE hit 0.2%, and year-over-year non-core stayed sticky at 3.7%.
Plus, GDP was revised down to 1.5%. Usually, a hot inflation print plus slowing growth is a nightmare, but the market is literally yawning.
Is that because investors think Nvidia's numbers can just overpower the macro gloom?
It's a factor, but don't forget the news out of Canada. They just unveiled $20 billion in retaliatory tariffs, which is about 5% of their exports.
Tariffs, hot inflation, and the Strait of Hormuz acting up? That's a lot of slop to trade through.
Matt is betting Jensen says three things tonight. Compute equals revenue, memory costs are rising, and agentic AI is the next platform.
If he confirms that compute is the new infrastructure, that $500 billion funding deal from last week starts looking like a genius move.
And if he doesn't mention the memory costs, does the whole AI trade lose its steam?
For today, stay patient. Your edge is at the extremes, 7,655 on the ES and 212.75 on Nvidia.
Don't fiddle in the middle. If we break 76.55, we could see a liquidation breakdown to the 7,600 level.
Got it. Fade the range extremes and wait for the 5 o'clock bell for the real fireworks.
Is it possible to be bullish on gold for protection, but still be completely exposed to a massive market crash?
Felix Prehn says yes. He's a former banker who sees retail investors bragging about gold while their 401ks are secretly just 5 tech stocks in a trench coat.
If interest rates are at 20-year highs, why is gold acting like money's free again?
Felix says the market doesn't believe the tough talk. They're watching the Treasury print money through liquidity support to manage $40 trillion in debt.
So the safe gold trade is actually fighting a backroom printing press?
Exactly. Felix says the government is essentially running a Ponzi scheme, selling short-term debt to the Fed to buy back long-term bonds.
It keeps the wheels turning, but it forces institutional money to look for hard assets that are actually scarce.
Right. That's why gold breaks out even when the official rates say it shouldn't.
If someone's just holding an index fund, they're diversified, right?
Not according to Felix. The S&P 500 is 50% A-rated now, and just 5 companies make up 30% of the index.
So buying Nvidia on top of that is just doubling down on a single bet?
Does Felix think this massive AI spend can actually hold up?
He expects a hard correction. We're throwing $700 billion a year at data centers, and he thinks returns won't match the hype.
Like the dot-com crash where the tech was real, but the stock still fell nearly 80%?
Precisely. He warns that when a trade is all over the news, it's usually too late to make money.
So if the AI trade is crowded, where is the skilled money going?
He's buying toll booth businesses like railroads and shipping. He just bought Norfolk Southern and Zim because they have real cash flow.
His rule is simple. Never buy a stock without a written exit plan. And watch volume. If the price rises while volume falls, the rally is fake.
And sitting in cash isn't an option because it's lost almost all its value since the 70s.
Jeff Snider is looking at the brewing grocery price war and says it's actually a major red flag for the economy.
Exactly. When Walmart doubles its usual discounts to cover 11,000 items, it's not a gift. It's a desperate move to keep shoppers from walking away.
So this price war isn't about competition, it's about survival in a weakening market? Wait, why is cheaper food a bad sign? Isn't that just inflation cooling off?
Not quite. Snider argues this is demand destruction. Businesses are losing the power to pass on costs because consumers are officially tapped out.
The data from the conference board is pretty grim. The expectations index just hit 68.2.
Right, and historically, anything below 80 is the danger zone for a recession. We aren't just near the line, we're way under it.
So people aren't just unhappy today, they're terrified about where their income is going tomorrow?
Policymakers keep pointing to a 4.1% unemployment rate as proof of resilience.
But Snider notes that if you include the 3.8 million missing workers and recent revisions, the effective rate is closer to 6.2%.
If the job market is this soft, what happens to retail margins?
They get crushed. We already saw Dick's Sporting Goods drop 27% because the sneaker market turned promotional just to move inventory.
Snider expects this no hire, some fire cycle to intensify as the economy basically forgets how to grow.
So what's the ultimate tell that this isn't just a temporary dip?
Watch that 80-point line on the confidence index. If we stay deep below it while grocery wars heat up, the recession is already here.
Basically, when the big chains start fighting for the last few dollars in your wallet, the macro story is over. And that's the full rundown for today. Want the final verdict, where these experts agree and where they clash head-to-head? It's in the video linked below.
Give this a like if it saved you time, and subscribe so you don't miss tomorrow's breakdown.